Welcome back to Switzer. Our next guest is an international investor and a serious player on Wall Street. He's Jan van Eck, the CEO of Van Eck Global, and he runs the Market Vectors ETF. Here's Peter Switzer's interview direct from New York City.
I'm Van Eck. Very nice to meet you.
Oh, it's very nice to meet you and to be on the show.
Yeah, and tell us about the history of Van Eck.
Van Eck Global was founded in 1955 by my father, John Van Eck. He was an American, but his father was Dutch, and he always had a view towards the world outside the United States, which I think we've carried through even to this day. We actually have ties to Australia because my father really made his name by starting the first gold mutual fund in the United States in 1968, before that bull market. And of course, Canada, Australia, and South Africa were the leading mining countries of the day. So our ties to Australia go way back.
So when did Market Vectors come along?
So we've had a fund business since 1955. In 2006, I started our ETF business, and we called it something different, Market Vectors, to communicate that we're trying to capture a slice of the market. And that was in 2006. And ETF assets are now about 2/3 of our overall business. So we manage about $32 billion overall, and 2/3 of that is in our 60 or so Market Vectors ETFs.
How long have you guys been in Australia for?
Well, we started getting going about 2 years ago, but we really just celebrated the first year anniversary of our first ETFs that we launched there at the end of last year, at the end of 2013.
So could you explain to my viewers the ETFs that you brought to the Australian market?
Sure. Well, the ETF business was already going gangbusters when we got involved, even back in 2006, and I understand it's an earlier stage in Australia, but our view is not just to be the second or third copycat provider. So what we're looking to do is provide unique exposures that probably don't exist in the market already. In the United States, the first 30 funds we launched, there were no funds like them. And so we've carried that through to Australia. I think we're most excited about our equal weight Australian equity fund, the MVW, on the ASX exchange.
Well, tell us about that.
Well, there's a theory of weighting stocks that diverges from market cap. Market cap is the traditional, so the bigger the company, the bigger weighting it has in the index. And researchers have found that by taking large caps and mid caps and equal weighting them, you accomplish certain things. First of all, you reduce the overexposure to some of the bigger companies, which would exist, or does exist, in a market cap weighted Australian index like the ASX 200. And so you reduce the risk of industry concentration sometimes and this mega cap concentration, and you get more of, some would argue, exposure to the overall economy by including mid caps. There's also, secondly, a kind of rebalance effect that people have noticed that that happens, because what you do when you rebalance is you're selling the stocks that have risen, and you're buying those that have fallen. And oddly, that rebalancing tends to add return on a relatively consistent basis.
Jan, what is it you want to become known for in Australia?
Well, we take a lot of pride in thinking through each one of our ETFs, and so if people are looking for Australian equities or international stocks, whatever it might be, that if they look at our funds as an alternative, they say, wow, they've thought through how they constructed that fund. I mean, we don't launch 20 at a time. We're very careful about each one. We tend not to do, I'll call them generic or commodity ETFs just based on general indices, but also desirable exposures or to sectors or parts of the market.
Have you found Australians keen to participate with ETFs?
Well, I think overall the Australian savings industry is extremely sophisticated. I mean, it's on the global stage. It has one of the third largest pension markets in the world, obviously at the institutional end. And at the individual end, it's always an issue of education and advice and things like that. ETFs are very new to Australia, They're a very small percent of the market in Australia and as a percentage of the global ETF business. But we found that people are very willing to look, being experienced investors, willing to look at the different approaches like equal weight that we mentioned.
How long have ETFs been going for?
They started, I don't remember the official launch date, but I would say in the late 1990s, people had always been trading baskets, even back in the crash of the late 90s, people with portfolio insurance had been trading baskets of securities, and they started getting packaged, I believe, right around that time in the late 1990s. Interestingly, original adoption in the US was by institutions that got this idea of an index and lower cost and transparent exposure. And then financial advisors and individuals got involved, and I think in Australia it's the reverse. That individuals and financial advisors are the earlier adopters, and the institutions somewhat.
I'm sure a lot of people wonder how ETFs, do in a crash, and you've seen a lot of crashes with ETFs. How do they perform?
Well, I think the topic, I'll call it, of liquidity of financial instruments, you could fill this room with books on that topic. And there's a lot of changes in the markets today because of financial regulation and the involvement of banks, which has been reduced here in the United States in terms of the amount of market making they can do, not only in the fixed income markets, which has been a drastic reduction, but also even recently in the commodity markets, which I think has had an impact. So it really depends on what the ETF is tracking. If it's tracking big, large cap US stocks, the ETF should trade very smoothly during the day. I would say the biggest test for fixed income came in what we call the taper tantrum of the second quarter of last year, when the market suddenly awoke to the fear of the rise in interest rates in the United States. That turned out not to happen, but the fear happened. During that episode, ETFs traded up to 5% below the NAV for a shorter period of time. I'll call it days and maybe a couple of weeks. And so for a less liquid market like fixed income, that was the dynamic that you saw. But for equities, there really shouldn't be any difference between where the ETF is and where the underlying assets are.
Do you have an opinion on the bull market?
Well, it's been a great recovery here in the United States for U.S. equities. Obviously not universally around the world. I think what we're most excited about right now is China. First of all, the Stock Connect program, which opened up 80% of the Chinese equity market to non-Chinese investors on November 17th, was to me the biggest event for investors in 2014 globally, because you had the third largest bond market in the world and one of the largest equity markets suddenly open to non-Chinese investors. And in 3 years, my view, or that time frame, it's a guess, Chinese equities will be part of global indices. So for whether it's an emerging market or even just a global equity index. So to me, that's a pretty big move. It's hard for people to see because so much of their reforms are incremental. And it's hard to say that is the change, but to me, that is the change. So just to get to your question very quickly, so the Chinese bond markets we think are attractive because we think they will be one of the last to participate in this global deflation trade where bonds have rallied globally from Europe to US. So the Chinese bond markets and then the equity markets, after being unloved for 3 years, 4 years, are trading at sufficiently attractive valuations, 11 times earnings for large caps to get people's attention, because all the fears of real estate bubble, credit bubble issue are so well known at this point.
So do you think the China story has been overcooked to the downside? And is there an opportunity for China to surprise, particularly the economy?
Well, I think there's the issues of are the fundamentals priced in? And it's hard to know because of the second issue, which is just the lack of understanding of the Chinese economy and markets, certainly I would say amongst many investors. For example, U.S. mutual funds effectively had the right or ability to invest in local Chinese investments a year ago through the RQFI program. I would say maybe 10 out of thousands of mutual funds have availed themselves of that capability. So that just shows you how slow our industry is to set up the mechanism to take advantage of what's available. So I think that kind of reflects that learning curve that the world global investors are on for China.
And I guess I have to ask the question, you know, what are the concerns for stocks going forward?
Well, let's go through the major risks. I think clearly there's not going to be major policy changes in the U.S. with a Democratic president, a Republican Congress, so that's probably status quo. It's doubtful that Chairman Yellen at the Federal Reserve is going to do anything drastic on interest rates. So it's hard to see a major change. We're comfortable with the world economy. So I think you want to keep your exposure to financial assets. That there will be bumpiness, but there's no reason not to own stocks and bonds.
Yeah, and do you think the Fed's going to take a long time before they raise interest rates?
Absolutely. If you looked at the futures curve of interest rates, they've predicted an interest rate increase 15 months out, last year, the year before, and the year before. So why should that curve be any better right now, since it's been wrong 4 years in a row? So they're expecting it whatever it is, second half of next year. We think Yellen will be no rush to raise rates.
Yeah, and thanks for coming on the Switzer program and sharing your insights with us.
Great to be here, Peter. Thanks again.
After the break, Peter will talk private wealth with one of the world's leading financial advisors. Stick around.